Let us pray. Heavenly Father, thank you for this beautiful day in Bradenton, Florida, this beautiful crisp day. Please pray for our club, its members, and those who cannot be with us today. Please cast your greatness on us as we come to the holiday season and make sure that everybody stays safe and healthy during this time of Christmas. For those who are eating, please bless this food to your health and for the hands that prepared it. We say this in your name. Amen.
Mac, do we have any guests that you want to share about?
Yes, ma'am.
All right.
All right. We want to give a really big welcome to some folks from the North Manatee Club. Barb Brisley and Pam Parmenter and Michael Sabatino are joining us this afternoon, and we really appreciate them showing their support and coming to listen to our guest speaker today. And just to let you know, anytime you all want to come and join us, you can be here live or you can be here on Memorex. Thank you. Have a good day.
Thank you, Mac. Okay, so we have a few announcements. We all know that we have to wear the masks while we're here once we're done eating. And I think everybody who's been coming to the meetings knows the drill, buying your ticket the Friday before. So I won't go through that again. We do have a liability waiver that you are supposed to sign if you're coming. If you don't have that, please let me know and I'll forward one to you so you can have it. We can keep it on file. Neil, do you have any announcements that you'd like to share? Oh, Neil says thank you to everyone. And that comes from me too. I know everybody's worked really hard on our service projects and we appreciate it. Any of our club committee chairs, if you have committee members that you need added to the lists online, please reach out to Mac or myself and we'll get them added for you. And if you need some help on knowing how to run Portal Buzz, let us know. We're happy to run through, just show you how it works. We will be having a club board meeting on Wednesday, December 16th. It will be held in the upstairs ballroom at Pier 22. And just as a reminder, we will not be having any club meetings on the 22nd or the 29th. Have a Merry Christmas. And I especially want to make sure everyone knows to come next week. If you miss next week, I think you'll regret it. It's going to be a really special program. Okay, so Gilbert, do you want to come share a page of Kiwanis history?
Hello, everybody. And we left off last week at the end of 1942. We're in the war. The war dominates the news every day in the newspaper, on the radio, in the newsreel at the theaters when people would go to the movies. There is so much that's going on the war, both in the Pacific and in Europe, that the newspapers cover just about everything that happens. And as the war rages on, the armed services are recruiting more and more people. Even the criteria that they had before the war started was lessened to where they are allowing people to be joined. And next week, I will be talking about some individuals that are in the war that were either members of this club or became members of this club, and some of the heroic deeds that they did in the war. Now, the big news in 1943 is something that's relevant today, and that is that the drug penicillin was developed. And just to put this in context, that was 25 years after the pandemic of 1918 that was during World War I. But in January of 1943, this club swore in a special person as its president, and that's Dr. Thomas Peter Chairs Jr. And there's some people that are probably in attendance that probably knew Dr. Chairs, but let me talk to you a little bit about him. At the Manatee River Hotel is where he was sworn in, and he He was an accomplished dentist in town, and he had his office in the professional building on Manatee Avenue. But he was well prepared to serve as the president, as a prominent dentist, and also as a prominent cattleman, which a lot of people didn't know at the time. You know, we have a lot of families in Manatee County who came here and started in the 1800s. And that was true of Dr. Chairs, but not in Manatee County. His family settled in Old Town, Florida, which is up near the Panhandle, and in the cattle industry. But rather than stay there with the family, which are actually, there's still family there, the Chairs cattle family up there, he went to Emory College, and then he went to the Atlanta Southern Dental College, becoming a oral surgeon. And by the time he arrived in Bradenton, he was well prepared to go forward with his dentistry practice. And as I stated, he went into the professional building where a lot of professionals were at the time. He joined the club not long after locating Bradenton, and he got involved in a lot of programs, and he got involved in the chamber. And a lot of people didn't know at the time that he had a strong interest and a background in the cattle industry. After World War II, he became a stable force and a leader in the Manatee River Fair Association. And a lot of people, I know Brenda Rogers knew Dr. Chairs, or at least knew of Dr. Chairs and his interest in there. In the newsletter, if you'll take a look at the newsletter, you'll see a picture of Dr. Chairs, but you'll also see a picture of what he was most proud of, even though he had an interest in dentistry, and that's what his profession was. There's a Brahma cattle that I have a picture of with him at the fair, and that was what he actually became fairly prominent throughout the state of Florida and the Southeast United States, and that is with raising Brahma cattle, and he was most proud of that. He got involved a lot with the Future Farmers of America and 4-H, and that's what he did his most work with the fair. And we have to remember that actually there's a picture of Dr. Chairs with his Brahma cattle. And you have to remember that we've already had, through our history, I've talked about agricultural extension agents as presidents of this club, but we had a lot of members, and our relationship with the fair is strengthened. And in doing so, Dr. Chairs strengthened that by being so involved with the fair as a president of Kiwanis also. Now, some interesting things with the Key Club. John Vita's here, who does so much with them, and Dick Briggs became the president of the Key Club, and Dewey Dye Jr. became the secretary treasurer. They were both students at the time. Another member, Paul Davis, who we're going to talk about soon, became the principal at Manatee High School. And what happened in 1943 is phenomenal compared to other businesses, and where this club started with this Bradenton Trailer Park. Remember, the Bradenton Trailer Park was started by this club during the Depression. Well, by 1943, by June, they paid off the debt. They paid off the mortgage. And so it was free and clear at that time. And they had a mortgage burning party at that time, and it was on the front page of the Bradenton Herald. Something else about this club, because we've been a first so much in this community, and that is that they started the community chest at that time, war chest, and which led into United Way. And so significant that during some of the worst times, this club has risen to the occasion to be a leader in the community. So often we're the first to do something like that. But the war continued to affect the membership of the club, and the recruitment was hard because so many of the men at that time were either going to the war, or they're working in some war effort. There's the slide that's now showing on the screen is January 1, 1943. And you can see there that the news, the headlines that was like that every day with respect to what was going on in the world. And that is that the news told us what was going on, and there were, most of the newspaper, in fact, was about the war. We inducted in 1943 3 members, Judson Burrell, Walter Harding, and Felton Scott, and that's all we had in that year as new members. And if there's another slide of another news, that it's hard to see that one. If you can see that, it's a little bit of levity by the newspaper. And this is December 24th, 1943. And that newspaper refers to the Allied bombers bombing Nazi land and wishing them a good tidings on Christmas Eve. So a little levity by the newspaper as to World War II and what was going on. And right under that is a picture of the wise men with goodwill on earth. And so the war dominates the news all the time. It's something that this club dealt with throughout. The club stayed focused on its mission for children, but yet retained patriotism with songs that it sang, with programs that it supported, buying war bonds, and also supporting the troops. And next week we'll go into a new president, which we'll have. His name is Harry Francis Botto, and he's going to own the theater in town. And we'll talk about his role with Kiwanis and his role also with the war. Thank you.
So thank you very much, Gilbert. And at this time, I'm going to ask John Vita if he would come up and introduce our speaker.
Thank you, Christy. I appreciate it. I'm going to take just a minute of personal privilege here just to make a presentation to the club. I think everybody was informed a few months ago that at the Key Club convention back in April of this year, this club was presented the Florida District of Key Club Malcolm K. Lewis Award as Club of the Year, and it was presented to Manatee High School. So I just wanted to pass that along to our club to display proudly before we put it back into the place at Manatee High School that it'll deserve and that it will be. So so there it is. It was a great year last year for our sponsored youth programs. This club was also presented with the award for being the most outstanding Kiwanis sponsor of Key Club in the state of Florida. So congratulations to everybody. I know I get to be the face, but thank you. But you all really do it. You all do all the hard work. So we appreciate that, and we appreciate that coming through how it does. And now it's my great pleasure to present to you a friend of mine that I've known for quite some time from the New York offices of Morgan Stanley, Vijay Chandar. Vijay has been working with Morgan Stanley since 2011. He came into our capital markets group as an analyst, where he followed several different sectors of the economy, and has since risen to a point where he works very closely with our Global Investment Committee, our chief strategist, our economist, and really is responsible for getting things out to us in the field on best ideas and things that and places that we should be looking to help our clients navigate through and to help them invest in. So I've had Vijay at several different events with me in Florida and Georgia and different places, and he's kind of been nice enough to fly all around, and I know he would have been here today rather than sitting in the ice cold up there, but and it's only about 60 here today, Vijay, so you're not missing too much. It's a little cold for us Floridians, But we really appreciate you being here. And he's just going to give us a little bit of an update and an outlook on perhaps what we can expect in the markets moving forward. So Vijay, I'm going to hand it over to you, my friend. Thanks for being here.
Absolutely. And, it's convenient how we try to schedule all these meetings for Florida down in December and January. And unfortunately, can't do much of that this year. So hopefully, not too long and we'll be able to get back down there, because you're absolutely right. New York City in the winter is not the most fun place to be. What I'll try to do maybe is just set the stage a little bit with what we're thinking at Morgan Stanley from a market perspective as we go into next year. We've lived through an incredible year. If you told us 7 or 8 months ago that the S&P 500 would be at a new all-time high, up 20% in the middle of a recession, it would have been tough to believe. So I want to just level set a little bit and talk about what we're seeing from a market perspective, what we think is coming down the pipe for the economy as we go into 21. And I'll give the punchline away to begin, and then I'll dive into some of the details. But look, fundamentally, we are quite constructive as we think about next year. In fact, just to kind of rewind a little bit and talk about where we're coming from, this time last year, when we put out our outlook at Morgan Stanley, we actually took a pretty cautious approach. As we came into 2020, our feeling was 10 years into an economic cycle, things were getting a little bit late. As good as the data was, and we didn't know what the catalyst would be, we felt like there were some excesses building in the economy, and that ultimately would mean a recession would come at some point in the next couple of years. By no means did we think the catalyst for that recession would be a global pandemic. By no means did we think the economy would face, unprecedented headwinds in the first 6 months of this year. But we were a little bit cautious. Now, fast forward to February, March, April, as the pandemic took hold and as the world grappled with COVID-19, we very quickly went out and aggressively became bullish. And back in March, we put out several calls with the view that the economy would see a V-shaped recovery in the second half of 2020 into 2021, and that markets ultimately would rally to reflect that. A lot of our clients asked us, if you guys were cautious before the pandemic, how does the pandemic possibly make you more confident to take a little bit of risk? And it's a very valid question. But our thinking back in the spring, and is still true today, is if we had got into an ordinary recession, if we didn't have the pandemic and we just had a typical slowdown, it probably would have been a lot worse from a market perspective. And let me explain why. As we dealt with the shock of the pandemic, as we dealt with the lockdowns, as we went into recession, we had something that was nobody's fault, right? And what that meant was the policy response would be unlike anything we've seen in history. And so our view earlier this year was that as bad as the news flow is, as bad as the virus data has been, ultimately from an economic perspective, because you're getting a tremendous response out of Washington, both in terms of the Federal Reserve as well as the CARES Act and fiscal stimulus, that this recovery would be unlike anything we've seen historically. And so our view has been that a V-shaped economic recovery would play out. And as we think about 2021, we still feel quite confident in that view. We actually think economic growth next year is going to be quite strong. And that's largely a result of two factors. First, the data to date, particularly the last several months, has actually been pretty strong. A recovery is taking place. And again, a lot of that has to do with the CARES Act and some of the money that went out from Washington that sort of kept people afloat. The second factor next year that we think leads to a dramatic recovery is simply animal spirits. After so much of the population has essentially been locked up or business activity has been restricted for 9 months, as we move towards having a vaccine, as we move towards a real reopening next year, we think you're going to see the consumer come back in a big way. It's hard to overestimate the impact of how much spending could pick up, particularly on services, right? Things like travel and restaurants and tourism, et cetera, after we've gone through a year where that spending has been so depressed. So from an economic standpoint, we actually feel pretty good about next year. When we talk about a V-shaped recovery, let me just explain what we mean. We think the U.S. economy gets back to the 2019 level. That's the high watermark by early next year. And we think we get back to the pre-COVID-19 trend rate growth by the middle to late part of next year, 2021. which would essentially mean we would have reversed the economic effects of this pandemic in about a year's time. And that is quite fast by historical standards. That's the good part of our outlook. Okay, we are very bullish about the economy next year. Where we're a little bit more tempered is when it relates to what comes from a market perspective. We put out our 2021 outlook at Morgan Stanley a few weeks ago, and at the time we laid out a target for the S&P 500 of 3,900. When we put that target out, it was close to 10% upside for the market. After this rally we've had, currently it's probably about 6% higher than we are today. That's pretty bullish in our view. What gets us a little bit nervous, though, is when I look at how much sentiment has picked up in the last couple of months. We now have one of the lowest price targets across Wall Street, meaning investors are increasingly very bullish. When we think about a market that's traded back to all-time highs, the S&P 500, I believe, has made 30 new all-time highs this year. I have to acknowledge that even if the economy gets better, a fair amount of the good news is already in the price, meaning with stocks at record highs, their markets are already discounting a fair amount of this growth story I touched on. So what does that mean for us as investors? Well, ultimately, if we have a fair amount of economic momentum left ahead of us, if we're going to see an accelerating economy into next year, and we think this kicks off a new economic cycle that could last for several quarters, it's too early to start thinking about taking off risk, right? The corollary we would draw is today is very similar to 2010 or 2011. We're early into a new cycle. Yes, it feels like stocks have come a long way, but ultimately, if profits are going to grow in the coming years, it makes sense to stay invested. That being said, we think what the last year has given us is an opportunity to retool where we take that exposure. And so our advice to investors today would simply be, you can protect yourself from record high valuations by focusing on the parts of the market that have been left a little bit behind, which also coincidentally are probably those same sectors that are going to do the best in the next couple of years as we have a reopening and profits grow. So we would just be careful in some of the really crowded, highly valued parts of the market, some of the COVID-19 winners, so to speak, and we would lean more towards some of the more traditional value and cyclical type stuff, opening beneficiaries. And that's where we think the upside is going to be, especially on a relative basis, as we go into 2021. A couple of other points I'll just make quickly, and then happy to take any questions. As we think about the outlook for next year, as I said, we're quite constructive on the economy. If there's something that goes wrong outside of the obvious risk, which is, COVID-19, it could very well be the interest rate market. We're dealing with record levels of government spending, right? The U.S. budget deficit this year is likely to exceed $4 trillion, trillion with a T. That would mean the budget deficit relative to GDP is going to be north of 20%. We've only run a deficit this size once before in history, and it was when we were fighting World War II. If the government is spending this type of money and borrowing that money, who's buying all the debt? Well, that's the second piece of the puzzle. A lot of it's the Federal Reserve. The Federal Reserve has printed $4 trillion of currency this year. They've used that monetary expansion to buy all this debt and essentially fund the government deficit. If the government is spending and if the Fed is printing, it should lead to inflation down the road. Now, I don't want to scare anyone. We don't think inflation is going to 4 or 5 or 6%, but off of very depressed levels, we think inflation is likely to return to 2 to 2.5% over the coming years. What does that mean? It means if you're buying bonds at yields of less than 2%, you are likely guaranteeing yourself a negative real return in our view. In fact, 75% of the global fixed income market today trades at a negative real return, a return less than inflation. And we think that has implications for investors. What are the two biggest ones? First, we just be careful having too much exposure to things that benefit from low interest rates. Meaning, if I own a lot of long duration bonds, several year out munis or treasuries, there could be interest rate risk next year. We think 10-year treasury rates which are at 0.9% today, they might move to 1.5 or even 2% in the next 18 months. We would just be careful with that move. Secondly, we think you want to give yourself some exposure to things that benefit should inflation pick up. So if this story I just told about big government deficits and central bank money printing continues, if the value of the dollar declines and inflation picks up, having some exposure to hard assets, things like commodities, things like real estate, could be a good long-term investment. And we like the idea of adding a little bit of that exposure as an inflation hedge today. Maybe the final thing I'll end on, and then happy to take any questions. I spend a lot of time speaking to clients, and I will say the biggest question we probably have gotten in the last 6 months is how the heck is the stock market recovering to all-time highs when we're still dealing with a fundamental situation in the real economy that doesn't seem that great? You know, a lot of the folks I talk to are business owners, especially small business owners. Business hasn't been great the last 7 months. In any case, folks have lost businesses, unemployment rates have skyrocketed. And I think a lot of folks have this idea that the stock market has disconnected from reality or is disconnected from fundamentals. I just want to explain that divergence for a second. As crazy as this year has been, what we've seen from a market recovery standpoint actually looks quite normal in historical context. And let me explain what I mean. The U.S. stock market bottomed on March 23rd of this year. The S&P, I think, touched 2,100. If we go back to the last week of March, and we look at the unemployment data, or the jobless claims data, the last week of March was a horrible week for this country. We had 7 million Americans file for unemployment benefits. We've never seen a number come close to that. The good news is that last week of March marked the peak for job losses. Since then, we've progressively seen just about every week fewer Americans filing for unemployment benefits for the first time. What does that mean? The stock market bottomed the same exact week the labor market stopped getting worse. That's what's supposed to happen in a recession. If we zoom out and just think about the monthly data, the unemployment rate spiked to 15% in April. Okay, it's unfathomable. So the stock market bottomed in March ahead of the unemployment rate peaking in April. What have we seen since then? 7 consecutive months of job creation. The unemployment rate has been cut by more than half. By no means are we out of the woods. A 7% unemployment rate is still quite high. A lot of people have left the labor force. There's a lot of ways to go in this recovery. But I want to be clear, the market bottomed ahead of the data sort of getting as bad as it could be. And a lot of progress has been made in the last 6 months. A couple of other economic data points I'll just end on that I think are really important and underappreciated. As bad as the first half of this year was, right? Historically bad recession. In the third quarter, we saw the U.S. return to double-digit GDP growth off of a very low base, right? Still down year over year, but the economy has returned to expansion. I mentioned the unemployment data. The biggest bright spot out there today and why we remain constructive into next year is the U.S. consumer. We can debate whether it was the right policy, whether the policy should be continued, but 2020 will be the first recession year in history where average household income actually grew. In fact, personal income in the United States as a result of stimulus has grown almost 5% this year. What that means is if the economy normalizes and folks get their jobs back, you have a lot of money, over $1 trillion, sitting in checking and savings accounts today that can ultimately be spent if we have a reopening. Retail sales, a measure of what people spend on physical goods and things, they collapsed 20% in the time period January through April. It took just 2 months for retail sales to recover. And in the last 3 months, retail sales have actually made new all-time highs. So the U.S. consumer is coming back. The U.S. consumer and U.S. households are sitting on a fair amount of savings. If we do get a reopening next year, we think that consumer is going to be a bright spot. And so I want to end on that note because I know there's so much bad news out there around the virus. There's so much to be worried about in the next couple of months. But if we can get through, this second wave or the next couple of months with COVID-19, there are a lot of reasons to be fundamentally optimistic about the U.S. economy and the U.S. consumer in particular next year. The thing we just want you to be careful about is making sure we don't pay too high a price to get exposure, given the run we've had in the market. So I'm happy to pause there, John. I don't know if we're able to take questions or if there's any questions on the webcast. Happy to address anything that might be on anyone's mind.
So yeah, if there's questions out there, if you just want to raise your hand, I think Janine can pipe you in to ask any questions, or if there's any questions from anybody here, please come on up and ask away here.
Do you feel that a lot of stocks are overvalued at this point?
Sure. So there are certainly some, and I think if we just look at how extreme some of the market reaction has been, and I think the next few weeks will be a great example of this. I can't tell you personally how many friends I have telling me, how great they've done this year. And, we can all point to a few of these stocks. I don't want to pick on any in particular, but there's an electric car maker that's worth $500 billion. That's, up 1,000% this year. There's a lot of things that are extreme. Now, again, I think the market is right to price some of this stuff correctly. If I think about, I'll use a few companies as an example. Amazon has had a tremendous year. We've gone through a recession and we've pulled forward a lot of this shift towards digitization. Is it right or wrong that some of these stocks have traded so well? We're going to have to figure this out over time. So here's how I look at it. By and large, the average stock in the US market, if we look at the index, the S&P 500 trades at around 23 times forward earnings today. That's a 23 times PE ratio. Historical average is around 15. So we're expensive any way you cut it. We've only traded above 20 times earnings for 2 years in history, and that was 1999 and 2000. Okay, we all know how that ended with the dot-com bubble. So I would argue stocks are probably fully valued at the index level. Now, ultimately, we're forecasting 25% earnings growth next year. So if earnings grow as we expect, that multiple comes back down below 20 times. I think it's reasonable. I think the second thing we have to clue in on is the fact that interest rates are very low. So if I can only get 0 or 1% out of, my risk-free rate, getting a 2% dividend yield out of equities might not sound so bad, right? So I approach it that I think the market is probably fully valued for where we are today. But underneath the surface, there could be pretty big disruption, or I should say divergence. So those tech stocks that I kind of joked about, they're trading at very high valuations. Some of the more cyclical stocks like banks, commodity-oriented businesses, industrials, they're not really trading at those sky-high valuations. And so what I think happens next year is you see some of those really expensive companies start to settle out a little bit, maybe some even trade lower. I think the things that have been left behind trade significantly higher, and in aggregate, that means the market kind of muddles along from here. So I don't want to say we're wildly overvalued by and large, but I do think we're probably pretty fully valued, just given how much the market is priced in the last 6 months.
Thank you. Dave, yep.
Where do they see commercial real estate headed with everybody, with so many people working from home?
Vijay, we have a question here in-house talking about commercial real estate, and if you care to comment on the real estate sector.
Yeah, so I'm going to give the biggest cop-out answer, which is, commercial real estate is so difficult to get a handle on today. Because look, I can't tell you with confidence what the world looks like in 3 years. And so do I feel like things are going to change as it relates to retail and office? Absolutely. What is the scope of that change relative to what the market is pricing is the big debate, right? And so, we were hoping to see a little bit more dislocation, to be honest, because that would have made it easier. If you saw office real estate trade down 50%, it would be a little bit easier stepping in and saying things aren't going to be as bad as the market is pricing. But you don't really have things down that much today, right? You had a little bit of a recovery. And so given how much retail and office has come back, it's difficult for me to have a high conviction view about there being a huge opportunity. If things got more distressed between those two, I think office could ultimately be more interesting. I think a lot of this space, particularly in the big cities, can get repurposed. I think work from home will be a real thing for a long time, but I don't think it replaces offices entirely. I can tell you from our experience at Morgan Stanley, the first couple of months of work from home, everyone thought it was great, right? Everyone sort of came out and talked about how productive we are, how this is, seamless. I can tell you 9 months later, the longer you go from a fully remote environment, it is very difficult to train new people. It's very difficult to retain a culture. And so as we think about next year and beyond, maybe it's not 5 days in the office, maybe it's 3, maybe it's 2 at home. I think there's going to be a hybrid model. but I think that need for an office will be there. So if we got more weakness in office prices, if things repriced, I'd be more interested. But to be honest with you, today, as I look at the market, it's difficult for me to see the obvious opportunities. Some of the retail stuff that's going to be difficult to repurpose is distressed. I don't know if I want to be buying that just yet. Some of the quality office stuff, if I could get it cheaper, would love to. I'm just not sure that kind of the value is fully realized just there. And I'll say, separate from your question, the biggest bright spot in the real estate market, and I'm probably not telling you something you haven't already heard, is housing. If we think about the long-term setup for housing, coming out of a housing crisis a decade ago, nobody was building new homes, right? We had, multi-decade lows in terms of new housing construction, housing starts. 5 or 6 years ago, the popular refrain was millennials were never going to buy a home, right? No one was going to move out of the basement. They don't value home ownership. Well, even before COVID-19, household formation spiked up. And so we had very strong demand trends for housing before 2020. And I'll venture to guess that after this 12-month period where everyone's been stuck at home, the value of home ownership has probably gone up, not down. And so if I think about that demographic story, a young US population that's entering that first-time home buyer, year, the psychological factors of COVID, and the fact that we've come through a decade where nobody built homes and housing supply is constricted, the residential real estate market should be quite tight, I think, for the next 5 or 10 years. And so in the real estate side, we've been gravitated more towards housing and kind of the home building, new construction market, as opposed to traditional commercial real estate. But again, everything I told you is probably a consensus view. So we just have to be mindful of, where our expectations and what's in the price.
And we're in Florida, everybody's coming here, so we got nothing to worry about.
So I hear.
Got another one in-house.
Yeah, it's along the lines of a housing question. We had all these phantom foreclosures and evictions that were halted during the pandemic. Is the outlook changed when those make their way through the court system?
So during the pandemic, there were a lot of phantom foreclosures and so forth. Does that change the situation as those make their way through the court system?
I think so. And I think, look, that is one of the things that I think we're going to be dealing with for the next probably 6 to 12 months is figuring out how much support are you going to get from federal and local governments, and what does that mean both in terms of protections for tenants as well as when some of those start to get lifted, and does that lead to the market to normalize? To be honest, though, relative to what we would have forecasted 8 months ago, the foreclosures, both realized and phantom, as well as some of the other kind of measures of defaults, have been a lot lower than we would have thought. Particularly on the residential side, I'd say payment of rents, at least nationally. I'm sure regionally there's pockets of weakness. But overall kind of rent payments, mortgage payments, things staying in compliance, the overall level of rates have been much higher than we would have expected back in February and March. And I think a lot of that has to do with stimulus, right? I think ultimately that the money was made available. And so, finances haven't gotten stretched. So if we're wrong on something, if I had to make the bear case, I think the bear case for both housing as well as the US economy would be that if we don't get more stimulus, if COVID-19 is a little bit worse than we think in terms of reopening, if next year you start to get more white collar layoffs, because up until this point, most of the layoffs have been concentrated in kind of the lower income sector. If you had a hit to income next year, you pulled away stimulus and the economy doesn't normalize, then some of these things could get a lot worse. But I've got to say, whether we're looking at, rents getting paid, whether we're looking at some of the credit data, credit card payments and kind of what's in default there, the credit activity has been very strong. We haven't really seen that big uptick in non-performing that you'd expect. Some of it's probably still going to come, but we haven't seen it yet, and that keeps us pretty encouraged.
Good. Anybody else? One more, maybe? We're good. Okay, Vijay, thank you so much. We really appreciate you being here with us today and taking the time as always. I'll talk to you.
Thanks, guys.
And Vijay, on behalf of Bradenton Kiwanis, oh, he's already gone? Oh, well, we thank him. That was fast. But thank you, John, for suggesting we have him come and speak. It might be nice to have him come back again as things go along. All right. Well, that being said, we want to thank all our guests for joining us today. And like I said before, make sure you come next week. Our next meeting is on December 15th. Judge Nicholas will be presenting our Christmas program, sharing his stepfather's story of faith in the midst of World War II as an Army chaplain. You don't want to miss it. Please invite others to join in on the Zoom. And if they want to come to the theater by Friday at 5, they need to go on the theater's, on the ticket site and buy their ticket. And with that, we are adjourned. Everybody have a blessed day.